Hello everyone, welcome to FinTalks. This is Dr. Hari Curry, PhD in Finance, having 22 years of experience in teaching and also industry. So, as a part of capital budgeting series, this is my third video. In first video, I was explained in detail about capital budgeting methods, traditional methods, payback period. In second video, I was explained about another traditional method, that is ARR, accounting rate of return or average rate of return method. And now today in this video, third video as a part of series 3, I am going to explain in detail about the modern techniques, that is also known as discounted or time adjusted methods. The capital budgeting methods, capital budgeting techniques tools, second category, that is modern methods, discounted time adjusted methods. So what is discounted methods, what is the difference between the traditional and these methods is, as I was explained in my previous video, in modern methods we are applying the concept of time value of money. What is time value of money? According to time value of money concept, the present value of money is always more valuable than the future value of money. Present value of rupee is more valuable than the future value of rupee. This concept is applied in the modern methods. How you applied? The future cash flows are converted into present cash flows. So the conversion of future cash inflows into present cash inflows by applying the time value of money is called as discounting. Discounting. How we will apply? With the help of the table values, the present value tables. So in modern method, discounted cash flow methods, we are taking the help of the table values, present value of rupee table values and present value of annuity table values. Example, these are the table values we are using here. You can see on the screen. The first table is present value table. This is the table values we are going to use, and one more table is there, present value annuity table. These tables link I will give in the description, and also these tables are available in Google. You can just search in Google, everywhere it is available. Present value annuity table and present value of table. So under the modern techniques, discounted cash flow method, there are mainly three methods are there. They are net present value method, profitability index method, and internal rate of return method. I will try to solve all the three methods together in the single problem, practical problem. So let us start. What is NPV, net present value method? The net present value formula is total present value of cash inflows minus total present value of cash outflows. So cash inflow or cash flow after taxes, all are same only. Depending upon the problem to problem, question to question, the sentence may change. These these variables may change, but the same meaning: cash flow, cash inflow, cash flow after taxes. So how you will get net present value? Total present value of cash flows minus total present value of cash outflow. Cash outflow means cost of the investment, cost of the project, initial investment cost. And generally, cash outflow is always in present value only, because you are investing today. You are investing today and expecting the cash inflows in future. So outflow is always present. Outflow is always present. There is no need to conversion. Already it is at present value only. Unless there is a requirement, we will not convert. Cash inflows are future cash flows. Cash inflows are future values. This has to be converted into present values. How you will convert? By applying the time value of money, by multiplying with the table values, present value table values at the required rate of return at a discounting factor at a cost of capital. So how you will get NPV? Total present value of cash inflow minus cash outflow. This is the technical formula. NPV equal to A1 divided by 1 plus K1 plus A2 divided by 1 plus K2. That is A1, A2 stands for the cash inflows. K stands for the discounting factor, that is table values. Time period stands for the first year, second year, third year. CO stands for the cost of investment, initial investment. This is the technical formula, but I gave the simple formula. NPV equal to total PV of CFAT minus total PV of cash outflow. Simple formula. And how you will make the decision, accept or reject. In case of single project, if the NPV is positive, the project will be accepted. If the NPV is negative, the project will be rejected. That is the decision criteria. In case of two or more projects, that is mutual exclusive projects, you will compare the NPV of all the projects, and the project which is giving maximum NPV, highest NPV, should be accepted, other should be rejected. That is the decision criteria. So this is about the NPV, net present value method. The second method, extension to the NPV method, another discounted cash flow method, modern technique, time adjusted method, is profitability index method. This profitability index method is also known as benefit cost ratio or desirability factor method. It is another simple method compared to NPV. If you want to understand easily, in NPV, the formula is total present value of cash inflow minus total present value of cash outflow. In profitability index, total present value of cash inflow divided by total present value of cash outflow. There in NPV you did minus, in profitability index we did division, divided by. The NPV will give you value in amount. The profitability index will give you value in ratio. That is the only difference. Total present value of cash inflow divided by total present value of cash outflow. And the answer will be, result will be in the form of ratio. And the decision criteria. In case of single project, if the PI, profitability index value, is more than 1, accept the project. If it is less than 1, reject the project. In case of two or more projects, the project which is giving maximum, highest profitability index should be accepted and other should be rejected. But it should be, minimum condition is it should be more than 1. So profitability index is just an extension to the NPV. If you measured the values of NPV is available, no need to calculate any extra additional values for the profitability index. Same, the values which you are used for NPV, by using the same values, you can measure profitability index. That is the thing. And the next, another method, third method of the discounted cash flow method is IRR, internal rate of return method. This internal rate of return method is also known as yield method or discounted rate of return method, and also known as trial and error yield method. Trial and error yield method. But most probably the preferable name is internal rate of return method. But others names also please keep in mind. Maybe in examination they will ask you different names. So what is IRR, internal rate of return? It is the rate of return at which the total present value of cash inflows are equal to total present value of cash outflows. It is the rate where present value of cash inflows are equal to present value of cash outflows. That means it is the rate where NPV is equal to 0. The rate at which NPV is equal to 0 is known as internal rate of return. Another you can explain another way. The rate at which PI, profitability index, is equal to 1. So it is the rate of return where cash inflows are equal to cash outflow. In other words, it is the rate at which NPV is equal to 0. In other words, it is the rate at which PI, profitability index, is equal to 1. So how to calculate IRR? There are two models practically possible in calculation of IRR. What are that? First model is calculation of IRR along with NPV. That means in the question you already calculated NPV, and after NPV then you are going to calculate IRR. That is model 1. In such a case you can apply an interpolation formula. So what you will do is, first of all we will check the NPV of the first one, NPV calculation, and you will see what is the value of NPV. Based on NPV you will make a decision. You have to calculate one more NPV at another rate of return. What is that another rate of return? I will explain you while explaining the practical problem. So already you calculated NPV at a rate of return, and now you have to calculate one more NPV at another rate of return, another discount factor, and then after that apply this formula, interpolation formula. What is the interpolation formula? Now you have with you two NPVs, two net present values, NPV at two different rate of returns. Then use this formula. Lower rate plus present value at lower rate minus cash outflow divided by present value at lower rate minus present value at higher rate, multiply with the difference in the two rates, two discounting factors, two rate of returns. If you apply this formula, then easily you will get the IRR value. The technical formula in the other way, this one, IRR, RL plus PV CFAT minus PVC divided by delta PV multiply with delta R. Same formula, technically I was explained in the simple way. Lower rate plus present value at lower rate minus cash outflow divided by PV at lower rate minus PV at higher rate multiply with difference in the rates. So this formula you will apply. Already you calculated, you measured NPV of the project at a particular rate of return, and you will calculate one more NPV at another rate of return, another discount factor, and now you have two NPV values with you. Apply this formula and you will get exactly IRR value. This is one model. Another model of IRR is, there is no calculation of NPV in the question. Directly they will ask you to calculate IRR. Some of the practical questions, they will ask you to calculate IRR with NPV, that is model 1. But here they ask you direct to calculate IRR, internal rate of return. And there is no information about any rate of return, discount factor, no information is available. So in such a case, how to calculate IRR? First you have to calculate fake payback period. How you will get fake payback period? Initial investment divided by average cash flows. And now what you will do is, take this value, fake payback period value, and go to the table present value annuity table. In present annuity table, check the number of years row. For example, the project is for 5 years, check in the 5th year row. In fifth year row, where you will get the nearest to your fake payback period, that rate of return we will consider assumption, and we will calculate NPV at that rate of return. And again we will calculate one more NPV at another rate of return. Once you have two NPV values, then you will use again interpolation formula, as like how you use in the before. So how to check the present value table, that everything I will explain you clearly while solving a practical problem. So in IRR there are two models. One is calculation of IRR along with NPV, which is very easy, and calculation of only IRR method. In such a case, you will calculate fake payback period, and you will identify this fake payback period from the present value annuity table and we will assume one rate of return, one discounting factor. By using that discounting factor, we will calculate NPV, and again we will calculate one more NPV at another rate of return discounting factor, and by keeping these two NPVs, we will use interpolation formula and we will calculate IRR value. So now I am going to show you practical problem solving using these three methods of discounted cash flow methods, time adjusted methods, modern methods, NPV, net present value method, PI, profitability index method, and IRR, internal rate of return method. Let us take an example here. And what about the decision in IRR? If the project IRR is more than the cost of capital, it should be accepted. If the project IRR is less than cost of capital, it should be rejected in case of single project. In case of two or more projects, the project which is giving maximum highest IRR should be accepted. That is the decision criteria. You will understand more clearly when I solve one practical problem now. Let us see. And this is the table I am using. I downloaded from the Google only. Any financial management textbook also, backside you will get these tables, and you can download from the Google also. Present value table at different rate of returns. This is 1%, 2%, 3%. The columns are rate of returns, discounting factors, and these are the number of years: 1 year, 2, 3, 4, 5, number of years, and continuation 11, 12 up to 20%. It is given table. And the second table is present value of annuity table. It is nothing but cumulative table. If you do cumulative for present value table, then you will get the present value of annuity table. It is nothing but cumulative table only. And where it is useful, will tell you. It is useful morely maximum in case of IRR method. So keep in mind these tables. I take the table values from here. These tables, my dear. And now let us see a practical question going to solve. Read the question. AQJ Limited is considering an investment proposal, the details of which are given below. You are required to advise whether to accept the project based on NPV, PI and IRR methods. The initial investment of the project is 200,000. Assume discount factor at 10%. If you want to calculate NPV, compulsory we need a discount factor. It's called as discount factor or rate of return or cost of capital. At this rate of return, we will use the present value table values. So project is given here. What is the cost of the project? Initial investment 200,000. And what about the cash life of the project? 5 years. What about the cash flows? Yes, cash inflows are given. Cash flow, cash inflow, cash flow after taxes, all three are same. So cash flows are also given. So cash outflow is given and cash flows are given and 5 is given and rate of the return is also available, and you have to calculate NPV. How you will calculate NPV? The formula for NPV is total present value of cash flow minus total present value of cash outflow. So how you will get present value of cash flow? You have to convert. So cash flows are given in the question. These cash flows you have to convert into PV of cash flows. How you will get PV of cash flows? By multiplying with the table values at the rate of given discount factor, 10% rate. So first of all, year column, and second column is cash flows. What is the value? 60,000, 65,000, 62,000, 61,000, 55,000. So cash flows are ready and given. Discount factor is given in the question 10%. So take the table values, present value table at the rate of 10%. I show you before, this is the table I use. This is the table, present value table. At what rate of return? Discount factor 10%. This is the column I took, present 10%. and first year 0.909, second year 0.826, third year 0.751, fourth year 0.683, fifth year 0.621. From this table, at 10% rate of return, 5 years, I took the values here. Present value is 10%. Now the column is PV of cash flows. So how we will get PV of cash flows? Cash flow multiply with present values, I mean 10% table values. That means 60,000 multiply with 0.909. 60,000 multiply with 0.909, that equal to 54, that equal to 54,540. Next, 65,000 multiply with 0.826, that equal to 53,690. Second year PV value. You are converting these cash flows. These cash flows are future cash flows. These future cash flows you are converting into present cash flows, present values. How you are converting? By multiplying with the present value table values. These values I took from the present value of table, present value of 1 rupee table. At what rate? At 10% rate of return. So now I will get how I got PV of cash flow. Cash flow multiply with present values will give you PV of cash flow. And next third year, 62,000 multiply with 0.751, that equal to 46,562. And next fourth year value, 61,000 multiply with 0.683, that equal to 41,663. And next last fifth year present value, 55,000 multiply with 0.621, that equal to 34,155. So 5 years present values are ready. And now do the totals. Total of the PV of cash flow, 54,540 plus 53,690 plus 46,562 plus 41,663 plus 34,155, that equal to 200,610. This is the value I got here. This is the answer. Total PV of cash flows. So total PV of cash flows is ready. Now I will substitute, find out the value of NPV. What is the formula for NPV? NPV is equal to total PV of cash flow minus total PV of cash outflow. Cash outflow means cost of the project, cost of the investment, and it is always in, keep in mind, always in present value only. It is always present value only. So that equal to NPV equal. What is the total PV of cash flow? 230,610 minus. What about the cash outflow? That is cost of the project, 200,000. So 200,000 is the value. That equal to, what is the NPV value, net present value? 30,610. 30,610 is the answer. So NPV of the project is 30,600 rupees. It is value amount in rupees. And now profitability index, PI. Simple. As I told you before, if you have NPV value ready already, calculation of PI is very easy. In NPV you did minus, In PI you will do division. That's it. If you want, I will write formula again. Formula: total PV of cash flow, that is cash inflow, divided by total PV of cash outflow. Outflow is nothing but cost of the project, initial investment, that equal to 230,610 divided by 200,000. That equal to what is the answer? Here you will get in ratio 230,610 divided by 200,000. That equal to 1.15. So this is the answer for the PI. NPV will give you in amount, PI will give you value in ratio. That is the only difference. So we calculated for this project, we calculated NPV, we calculated PV, and then next is IRR. And here we are calculating IRR after NPV. That means we already calculated NPV at a rate of return. What is the rate of return? 10%. So you already have a NPV at rate of return. If you calculate one more NPV at another rate of return, then you can use interpolation formula and you can calculate IRR easily. So now you have to calculate one more NPV at another rate of return. How you will know? How you will calculate one more NPV at another rate of return? What is that another rate of return? How we will know that is another rate of return? Simple logic. What is IRR meaning? IRR is the rate of return at which cash inflows are equal to cash outflows. That means here cash inflow and cash outflow both should be equal. That is NPV equal to 0. That means this 23610 also should be 200. If this 23610 is also 200,000, then 200,000 minus 200,000 will equal to 0. NP will be 0. That is so if you want to get this 23610 is equal to 200,000, that means you have to reduce the value. In order to make this both of them equal to get the NPV 0, simple logic, this 23610 has to be decreased. The value has to be decreased. If this value of total PV of cash inflow should be decreased, means you have to try another rate of return, high rate of return. If you have to decrease the value, you have to try high rate of return. If you want to increase the value, you have to try low rate of return. In this problem, we have to decrease the value. This 23610 should be 200,000. That is the IRR actually. To reduce the value, decrease the value. If you want to decrease the value, you have to increase the rate of return. Increase the rate of return means increase the discount factor. Already you calculate NP by 10%, now increase it more than 10%. You can take it as a 12%, 13, 14, 15, anything more than 10 you can try. There is no any rules. It is a trial and error method. So that's why in order to decrease this value, you have to try increase rate of return, increase discount factor. Increase discount factor means already you have calculated at 10%. Now increase that. How much? More than 10. Go for 11, 12, anything. So let us assume I will take it as a 12%. Let us calculate one more NPV by taking discount factor 12%. I hope you understand why I am taking 12%. because you have to take the rate more than 10%. More than 10% means you can try anything, 11, 12, 13, 14, no issues. Just here I took 12%. Why you have to take more than 10% means you have to decrease this one. If you want to decrease this value, you have to increase the discount factor. If you want to increase this value, you have to decrease the discount factor. Opposite relation you have to take it. So in this problem, since I want to decrease this value, I am using increase discount factor, more rate of return, that is 12%. So let me take here again present values. Now this column again, but here I will take now 12%. Keep in mind 12%. So what is the table values at 12%? Present value at 12%. See here, this is the column, yes, 12% column. Present value 12% column, and I need for the 5 years values. First year 0.893, second year 0.797, third year 0.712, fourth year 0.636, fifth year 0.567. So first year 0.893, 0.893, 0.797, 0.893, 0.797, 0.712, 0.712, 0.636. I am taking the values in front of you from the table. 12% column, first year, second year, third year, fourth year, fifth year, 0.567, 0.567. So I am trying to calculate one more NPV at another rate of return, another discount factor, which is more than 10%. So more than 10% means I am trying at 12%. That's it. And then I calculate here again PV of cash flows. Here PV of cash flows means cash flow multiply with present value at 12%. This is the new PV of cash flow, that is cash flow 60,000 multiply with this value 0.893. That's what I am going to do here. So 60,000 multiply with 0.893, that equal to 53,580. Next, second year 65,000 multiply with 0.797, that equal to 51,805. And third year 62,000 multiply with 0.712, that equal to 44,144. Next, fourth year 61 multiply with fourth year table value, PV table at say 12%, 0.636, that equal to 38,796. And then last fifth year PV cash flow 55,000 multiply with 0.567, that equal to 31,185. Now calculate the total values. Total of all 5 years PV of cash flows at 12%. 53,580 plus 51,805 plus 44,144 plus 38,796, 38,796 plus 31,185, that equal to, I added these 5 values, my dear. These values 219,510. This is the total PV of cash flows at 12% discount factor, 12% rate of return. And now I will calculate again one more NPV. NPV at the rate of 12%. So total PV of cash flow 219,510 minus PV of cash outflow, that is cost of the investment, 200,000, that equal to 19,510. 19,510. So I have one more NPV. This NPV is at the rate of 10%, and this NPV at the rate of 19,510 at the rate of 12%. Now we have two NPVs at two different rate of return, that is 10% and 12%. So now you can apply interpolation formula for IRR. What is the interpolation formula? Just now I told before, this formula we will apply. Apply the interpolation formula, IRR formula, you will apply this one. What is this formula? Lower rate plus, so lower rate plus, what is the lower rate here? 10% and 12%. Lower is 10% is the lower one. So lower rate plus present value at lower rate, I mean PV of cash flows at lower rate minus cash outflow. Let me substitute the values. Lower rate 10% plus, and in brackets I am keeping PV of present value at lower rate, that is PV of cash flows, this one, 23610 minus cash outflow 200,000 divided by, so I am keeping this in the brackets for easy calculation purpose, divided by PV at lower rate. PV at lower rate means 230,610 minus PV at higher rate. This is the PV at higher rate. Present value of cash inflow. This is total present value of cash inflow. At higher rate means 12%. Out of 10 and 12, 12 is the highest one. This is NPV at the rate of 10%. This is NPV at the rate of 12%. So here, this is 10%, this is 12%. So PV at lower rate 23610 minus PV at higher rate. This is 219,510. 219,510. This I will keep separately in the brackets, no confusion. And now the bracket close. Multiply with difference between two rates. One rate is 10%, one rate is 12%. What is the difference? 2%. 2% means 12 minus 10. Difference of 12 minus 10 is 2. That is it. And now let us again calculate 10 plus, I will do the brackets value first. 230 minus 200 means 30,610 divided by 230,610 minus 230,610 minus 219,510, that is 11,100. So brackets close. Now multiply with 2. Again 10 plus, so here, sorry, 230 minus 610 is 36. So sorry. So here 30,610 divided by 11,100. That means how much you are getting? 2.7576 almost I got. And here multiply with 2. That equal to, the final answer is 10 plus, this is multiply with 2 will give you 5.51. So that equal to 15.51. The IRR 15.51%, my dear. This is the value, our answer, IRR. In order to calculate IRR, you have to apply interpolation formula. If you want to apply interpolation formula, we need two NPVs at two different rate of returns, two different discounting factors. In this problem, we already calculated NPV at the rate of 10%. So, I calculated one more NPV at 12%. Why you took 12%? I have to take more rate of return, more discounting factor. Why you have to take more discounting factor? Because IRR is the rate where cash inflow should be equal to cash outflow. This 230 should be equal to 200. If you want to make this equal to 200, this value should be reduced. If you want to reduce this value, you have to increase the rate of return. If you want to reduce this value, you have to increase the discounting factor. Anything more than 10 is okay. You can try 11, 13, 14. But I tried at 12% and I have one more NPV. Now I have two NPVs. Then I substitute the values in the formula. Out of 10% and 12%, which is the lower rate? 10% is the lower rate. So I took 10. 10 plus present value at lower rate minus cash outflow. So and at 10%, this is present value and this is cash outflow. 230, sorry, 230, 610 minus 200,000 and divided by PV at lower rate, that is 230, 610 minus PV at higher rate. This is the PV at higher rate. So 219, 510. So here numerator if you minus 30,610, if denominator if you minus, that is 11,100, and now do the division and then multiplication and then last plus 5.51. The total IRR, internal rate of return of the project, is 15.51%. Now coming to the decision, normally that I told you, decision for NPV, decision, NPV, how you will take the decision? If NPV is positive, accept. NPV is negative, reject. Since NPV is the positive, you can accept the project. See, NPV 30,610 positive value. Since NPV is the positive, accept. Accept the project as NPV is positive. What about the next one? IRR. If IRR is more than 1, you can accept the project. So IRR is 1.15, more than 1. Again same. Accept the project. Accept the project as PI. Sorry, PI is the profitability index is more than 1. You can accept the project. Accept the project as PI is more than 1. Is PI is more than 1. And what? Sorry, this is PI, my dear. Sorry, PI, profitability index. NPV, project is positive, accept. Project is negative, reject. PI, the project is more, the PI value is more than 1, accept. Less than 1, reject. What about IRR? IRR, you will compare with your cost of capital of the company. If the IRR of the project is more than the cost of capital, accept the project. If IRR of the project is less than the cost of capital, reject the project. That is the decision for the IRR. So this is the calculation of the NPV, PI and IRR. NPV, PV of cash flow minus cash outflow. Profitability index, PV of cash flow divided by PV of cash outflow. And what about IRR? Here you have to calculate IRR. We need interpolation formula. If you want to apply interpolation formula, we need two NPVs at two different rate of returns. One is already at 10%. Now we calculated another NPV at 12% rate of return. This is the 12%. Why 12% means you have to decrease this value. So you have to increase the rate of return. That's why we tried more than 10. I tried at 12%. Now two NPVs are ready. Interpolation formula apply and you got NPV of 15.5%. So you have NPV calculated, PI calculated, IRR also calculated. This is the one problem solving calculation. I hope you understand. Let me explain one more problem. One more example I will explain in detail. A company is considering an investment proposal to install new milling controls. The project will cost 50,000. That is cost of the project. Initial investment, outflow, cash outflow 50,000. The company's tax rate is 55%. Use a straight line method of depreciation. The estimated cash flows before taxes are as follows. So here cost of the project is given, life of the project is given, but the cash flows are not cash inflows. They are cash flows before taxes. CFBT. Cash flows before taxes means before depreciation and tax. Before deducting depreciation and tax. That is, depreciation and tax both are included. But what we need cash flow, CFAT. We need CFAT, but they have given CFBT. So from CFBT, you have to calculate CFAT. From cash flows before tax, you have to calculate cash flows after taxes. You are required to compute the below assuming discount factor 10%, NPV, PI and IRR. So in order to calculate NPV, PI, we need PV of cash flows. PV of cash flows after taxes. But we don't have cash flows after taxes. They given in the question they gave only cash flow before taxes. So first we prepare a table which converts CFBT into CFAT. So let us prepare the working notes table. This is the table I prepared. See, year 5 years and what they gave in the question, CFBT. CFBT. How much CFBT? 10,000, 11,000, yes, 11,000, 14,000, 15,000, 25,000. These are CFBT. Before deducting depreciation and tax. From this, first we have to minus depreciation and after that you have to minus tax and again add back depreciation. If you add back depreciation, then we will get cash flow after taxes. So let me calculate depreciation. How we will get depreciation value? Depreciation is equal to cost of the project or cost of the investment divided by life of the project. If you have any scrap value, anything, we will minus that, but here nothing is there. So that equal to cost of the project 50,000 divided by 5, that equal to 10,000 PA. That PA means per annum, per year, 10,000 per year. So let me take here. So depreciation per annum is straight line method, every year same. Straight line method of depreciation every year same. 10,000, 10,000, 10,000 and 10,000. So now profit before tax. How you will get profit before tax? CFBT, cash flow before tax minus depreciation. 10,000 minus 10,000, 0, nil. 11,000 minus 10,000, 1,000. 14,000 minus 10,000, 4,000. 15,000 minus 10,000, 5,000. 25,000 minus 10,000, 15,000. Yes. And now tax at the rate of 55%. You have to calculate 55% on this profit before tax values. So here 55% on nil. So it is nil, nothing. Here 55% on 1000, that is 550. Next 55% on 4000, that equal to 2200. Next 55% on 5000, 5000 multiply with 55 over 100, 0.5, that equal to 2750. Next 55% on 15,000, that is 15,000 multiply with 55%, 8,250. So now tax at the rate of 55%. And next profit after tax. How we will get profit after tax? Profit before tax minus tax. Minus tax. So here nil minus nil, nil only, 0. Here profit before tax 1000 minus tax 550, that equal to 450. Here 4000 minus 2200, 1800, if I am not wrong, yes. 5000 minus 2750, that is 2250. 15,000 minus 8,250, that is 6,750. Yes. So profit after tax means profit before tax minus tax. And last value CFAT, cash flow after taxes. How you will get CFAT? Profit after tax plus depreciation. Profit after tax plus depreciation, this value. So here profit after tax first year 0, nil, nil plus depreciation 10,000, that is 10,000, sorry, here. So here first year profit after tax nil, 0 plus depreciation 10,000, so value 10,000. And second year profit after tax 450, 450 plus depreciation 10,000, 10,450. Third year profit after tax 1,800 plus depreciation back 10,000, so 11,800. Fourth year PAT plus tax plus depreciation back, add back 2,250 plus 10,000, 12,250. Fifth year 6,750 plus add back 10,000 depreciation, 16,750. So in order to calculate NPV, we need cash flow after taxes. But in this question, they gave cash flow before taxes. So from cash flow before tax, we calculated cash flow after taxes. This is what we need. How you got this value? We got this value by using this one, cash flow before tax minus depreciation. It will give you profit before tax. Profit before tax, calculate tax at the rate of 55%. Then profit before tax minus tax will give you profit after tax. Profit after tax plus add depreciation back, cash flow after taxes. And for the purpose of discounted cash flow method, NPV method, you have to convert this cash flows are future values. You have to convert future values into present values. How you will convert into present values? By multiplying with the table value, present value tables. Present value of rupee table values at the rate of, in the question they give rate as a 10% rate of return, 10% discounting factor. So at 10%, these are the table values. I already show you how to get the values. From the table I took these values. And now PV of CFAT. How you will get PV of CFAT? CFAT multiply with the present value tables at the rate of present value of table values at the rate of 10%. 10,000 multiply with 0.909, that is 9,090. 10,450 multiply with 0.826, that is 86,000, sorry, 8631.7. 31.7, let's make it to the round of to 32. And next to 11,800 multiply with 0.751. Third table value 8862, round up to 62. And next 12,250 multiply with fourth year table value at the rate of 10%, 0.683, that equal to 8367, round up to 67. And then the last year 16,750 multiply with 0.621, that is 10,000, 1.75, round up to 402. So these are the values I calculated. How you got these values? The CFAT multiply with present value table, and now total I want. Total how much? 9090 plus 8,632 plus 8,862 plus 8,367 plus 10,402. Little round off I did here. 45,353. Yes, 45,353. Total PV of cash flow. Total PV of cash flow after taxes. This is the value we got. And now let us substitute in the formula. What is the formula? NPV formula. Already I have before the formula. So this is the formula I am using here. Same NPV at the rate of 10%. The formula is here. Total PV of cash flow. Here CF, I told you. Some questions they will give cash flow, some questions cash inflow, some questions CFAT they will give. Total PV of CFAT minus total PV of cash outflow. So that equal to total PV of CFAT how much? 353 minus cash outflow how much? Cost of the project 50,000. So we got the negative value minus. So 50,000 minus 45,353. We got a negative value. Since negative value I am keeping in the brackets. How much I got? 4647. So negative NPV made. Here we got NPV in negative. Keep in mind. Next PI, profitability index. What is the formula for profitability index? Same. Instead of minus, divided by. What is the formula? I am repeating here. What is that? Total PV of CFAT divided by total PV of cash outflow, that equal to 45,353 divided by 50,000. That equal to, let me see how much. 45,353 divided by 50,000, that equal to 0.90. Sorry, yes, 0.90. We can round up to 0.91. So it is less than 1. The PI value. See, if NPV is positive, PI will be more than 1. If NPV is negative, PI will be less than 1. Simple common sense. Instead of minus, we are doing here division. If NPV is positive, PI will be more than 1. If NPV is negative, PI will be less than 1. And next to IRR calculation. As I explained in previous question, if you want to calculate IRR, you have to apply interpolation formula. In order to apply interpolation formula, we need two NPVs, two net present values at two different rate of returns. We already calculated NPV at the rate of 10%. we need one more NPV at another different rate of return, another discount factor. What is that? We will see now. I told you before problem in the previous question, at IRR, the PV of cash inflow should be equal to PV of cash outflow. That means here the PV of cash flow is, total PV of cash flow 45,353. It should be 50,000. If it is also 50,000, then 50,000 minus 50,000, NPV will be 0. So here the value should be increased. You have to increase the value. If this value should be increased means the discount factor, rate of return should be decreased. In previous, if you compare the previous problem, we are doing opposite here. See, this value should be 50,000. So that 50 minus 50 you will get 0 here. That is the IRR. So if you want this value at 50,000, this value should be increased. If you want to increase the value, you have to decrease the rate. So decrease the rate means less than 10%. You have to try at less than 10%. Less than 10% means you can go with 9%, 8%, 7%, any percentage, any discount factor, any rate of return below 10% you can try. And I will try at 8%. I will take it at 8%. So let us calculate one more NPV, assuming 8% discount factor. It is called as discount factor, or it is also called as rate of return, or it is also called as cost of capital. Why I took 8%? It should be below 10%. Why it should be below 10%? See here. When I calculated the rate of NPV 10%, I got here 45,353. I got NPV negative. So if I got NPV negative, I have to increase this value. If I want to increase this value, I have to try another NPV at a discount factor which is less than the 10%. Increase the value, decrease the rate. Decrease the value, increase the rate. So here increase the value, decrease the rate. What is the decrease the rate? Rate below 10%. Below 10% means anything you can try, 9, 8, 7, 6%. I am trying at 8%. So I prepare one more table. This is the table I am taking. Here I have to, one more column I want to include. Insert, right? So this is wrong. This is, I will try at 8%, as I told before, less than. And here, and this is CFAT. So here I took taking from the value 5 years, copy paste. And CFAT, I already calculated CFAT here. This is the column I calculated. From here I am taking CFAT. I have CFAT and PV at the rate of 8%. At 10%, now at 10%, now I want it. So present value of one, table values. I have table values before I show you with you this one, where I have the here. And as 8%, as 8% column, 8% column. What are the values at this 8% column? First year 0.926, 0.857. I don't have tables with me. I have to copy from here. 0.926, 0.857, and then what next? This is the table values at 8% and 0.794, 0.735, 0.794 and 0.735, and I need one more for 5th year. 8% table value, 0.794, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, 0.734, 0.735, and I need one more for 5th year. 8% table value, At fifth year I want. Fifth year 8%. Fifth year how much I have? 0.681. 0.681. 0.681. So this is the table values I took in front of you only. These are available everywhere in the Google. Now PV of CFAT, that is cash flow after taxes multiply with the PV, present value table values, at the rate of 8%. So first one 10,000 multiply with 0.926, 9260. Sorry, 92 number 9260, and then next year 10,450 multiply with 0.857, that is 8955, round off to 56. Next third year 11,800 multiply with 0.794, that equal to 9369 after round off. Fourth year 12,250 multiply with 0.735, that equal to 9,004 after round off. Next to fifth year 16,750 multiply with 0.681, that equal to 11,407 after round off. So these are the values I calculated. Let me make it there. And now I want total PV of CFAT. Means adding sum of the all PV of CFAT column. 9260 plus 8956 plus 9369 plus 9004 plus 11,407, that equal to 47,996 only I got. So I got another PV of CFAT, and now apply one more NPV. One more time NPV. Now NPV at the rate of 8%, equal to total PV of CFAT minus this one. And how we will get total PV of CFAT? 47,996 minus cash outflow, PV of cash outflow 50,000, that equal to, still I got minus only, but little nearer to the 50,000, that is 2004. Minus value I am keeping in the bracket. Minus value, since it is minus, I kept it in bracket. So I calculated PV, NPV at the rate of 10%. I got minus 4,647. Then I tried another value, another PV, NPV at 8% calculation. Again I got minus only, but here minus 4,647, here minus 2,000, little reduced. So it is a trial and error method, but we can use the formula, interpolation formula. We can apply the interpolation formula. What is the interpolation formula? Yes, we have two NPVs. There are two NPVs in front of you. Two NPVs are there in front of you. This one is lower, one is 10%, one is 8%. So both are there in front of you. You can start the calculation. Apply the formula. IRR equal to lower rate plus present value at lower rate minus cash outflow divided by PV at lower rate minus PV at higher rate, multiply with difference in the rates. What are the two rates I have with me? 10% and 8%. NPV at 10%, NPV at 8%. Which is the low rate in this one? 8% is the low rate. So that equal to lower rate. What is the lower rate? Equal to 8%. Okay. And then brackets and small bracket. Sorry. PV at lower rate, that is 47,996 minus cash outflow. Sorry. 50,000 by PV at lower rate 47,996 minus this brackets. PV at higher rate means 10%. What is the PV at higher rate? PV means present value, total present value at higher rate 45,353. So 45,353 bracket close, multiply with difference in the two rates. One is 8%, one is 10%. What is the difference in two rates? 2 is the difference. Yes, one more step. 8 plus brackets. Let me take here one more step for you. 47,996 means I got here minus value. So minus how much I got here? 2004. Minus 2004. Okay. And divided by 47,996 minus 45,353, that equal to 2643. And this is also I will keep in the brackets, small brackets. And now multiply with 2. One more step I am calculating. 8 plus, okay, now in the brackets, minus 2004 divided by 2643. Minus 2004 divided by 2643, that equal to, you got here minus 0.7582, bracket close, multiply with 2. So one more step I am going to calculate, that equal to 8 plus, and here we have minus value, minus 0.758.7582 multiply with 2, that equal to 1 minus 1.5164, that equal to, plus into minus minus, so 8 minus, plus into minus will be minus, so 8 minus 1.5164, that equal to 8 minus 1.5164, 6.48, the percentage. The internal rate of return calculated for this project is 6.48%. Again, I calculated NPV at two different rate of returns, 10% and 8%, and substitute the values in interpolation formula. What is interpolation formula? This is the formula which I used before also. Out of two different rate of returns, 8% is the lower one. So let us take 8% plus PV at lower rate minus cash outflow. This is the PV at lower rate and this is the cash outflow. So 47,996 minus 50,000 divided by PV at lower rate minus PV at higher rate. That is PV at higher rate means 45,353. Multiply with difference in two rates means difference between 8 and 10 is 2. Difference you have to take just 2. No plus, no minus. Difference 2. So here numerator is minus, I got minus 2004 divided by denominator 2643. So if you do calculation division, minus 0.75. So minus 0.75 to multiply with 2 will be minus 1.5164. So plus into minus, minus 8 minus 1.51 means 6.48. So it is around 6.5, 6.48. Nearest one I took. So at the rate of IRR is 6.48%, total PV of cash inflows are equal to total PV of cash outflows. If you want, you can cross check by taking the PV at 6.48%. So at the rate of IRR 6.48%, NPV will be equal to 0. At the rate of IRR of 6.48 percentage, PI, profitability index, will be equal to 1, equal to 1. Why? Because PV of cash inflows are equal to PV of cash outflows. So if you do minus NPV equal to 0, if you do division, PI equal to 1. This is how to calculate IRR by using along with NPV. We already calculated NPV at a particular rate of return. We need one more NPV at another rate of return. What is that another rate of return? It may be more than this or maybe less than this rate. So here less than 10%. How? Here I have to increase this value. If I want to increase the value, rate should be decreased. Rate should be below 10%. Below 10% means anything you can take. I choose 8%. Then table value at 8%. Conversion PV of CFAT, total PV of CFAT. Calculate one more NPV. After one more NPV, two NPVs are ready at 10% at 8%. This is minus value I kept in brackets. Then substitute the values in interpolation formula. Then you got answer. IRR is equal to 6.48 percentage. Decision simple. If NPV is positive, accept the project. NPV is negative, reject. NPV is negative, reject. What about PI? If PI is more than 1, is less than, PI is less than 1, reject. Here PI reject, less than 1, reject the project. What about IRR? Compare with the given cost of capital, minimum required rate of return. If IRR is more than the cost of capital, accept. If IRR is less than cost of capital, reject the project. So this is how to calculate. I explained all the three methods with another example. But in this problem, CFAT is not given directly. CFBT is given. CFBT means cash flows before tax. That is before depreciation and before tax. So first I minus depreciation, then minus tax, then again add back depreciation, then you will get CFAT. So CFBT given minus depreciation, minus tax and plus depreciation back will give you CFAT. That is how you will get CFAT values and apply the formula. This is the IRR calculation along with NPV. One more example I am calculating here, only IRR. What is that only IRR? See, in previous problem we have NPV. So already we have a particular discount factor is ready. So we took a decision either more rate of return or less rate of return by seeing the NPV. But here there is no NPV, nothing. If a project requires 50,000 as an initial investment and the annual cash flows for the next 5 years are 10,000, 15,000, 12,000, 10,000, 16,000, you are required to calculate project IRR. So they are asking you direct to calculate only IRR. If they ask you to calculate only direct IRR, no other NPV, nothing, then you have to calculate here first fake payback period. Why? We have cost of the project 5 years, cash flows are given happy, but IRR means if you want to apply the IRR formula, interpolation formula, we need two rate of returns, but we don't have even one rate of return is not given. So let us we have to assume something. How will assume? Based on the fake payback period formula. So where is that formula? Before I explained in the notes, let me go and take the formula here. Fake payback period, where it is S. This is the formula, fake payback period. So this is the fake payback period I am going to use in this formula. What is the fake payback period? This is the formula. Fake payback period equal to initial investment divided by average cash flows. What is initial investment? 50,000. initial investment is available is given equal to 50,000. Then what about average cash flows? Average cash flows equal to total cash flows divided by number of years, that equal to, what is the total cash flow? 10,000 plus 15,000 plus 12,000 plus 10,000 plus 16,000. 25, 35, 37, 47, 57, 63. 63,000 divided by number of years 5, that equal to, how much I got? 63,000 divided by 5, that is 12,600. So 10, 25, 35, 37, 47, 57, 63. So now fake payback period equal to, sorry, now fake payback period is equal to total cash flow divided by number of, sorry, fake payback period equal to initial investment. Initial investment 50,000 divided by average cash flow 12,600, that equal to 50,000 divided by 12,600, that equal to 3.968. Yes, this is fake payback period. Now you have to identify this value in the present value annuity table. You have to identify this value in the present value annuity table. From there, we will assume one discount factor, one rate of return we will assume. So let us, this is 3.968, remember in mind, and let us go to the annuity table. What is the life of the project? 5 years. Okay, let us go back to the annuity table, where I have, here I have annuity table. Okay, in annuity table column, see the fifth year row. So fifth year row, in fifth year row, check one by one where you will get 3.968 or nearest value. 3.968, 3.968, nearest value at least 3.968, 3. Here see, it is not 3.968 but nearest one 3.99. This is 3.890. So 3.993 is nearest to the 3.968, and this value, see the above this column, this 3.993 which is nearest to our fake payback period 3.968, and this column heading is 8%. This value lies in the column under the 8%. So let us assume discount factor at a 8%. Let us assume rate of return as 8% and take the table value at 8%. Again I am repeating, we got fake payback period 3.968. Come to the present value annuity table. What is the life of the project? 5 years. Go to the fifth year row. In fifth year row, check one by one value which is nearest to 3.968. Nearest to 3.968 is 3.993. Okay, let us make a mark this one. This value is under which column? 8% column. That means let us assume rate of return discount factor as a 8%. 8%. And let us calculate PV table values at 8%. See, I am writing here. This value 3.968 found in present value, not exactly, I didn't found nearest value, found in present value annuity table, fifth year row, under 8%, 8% rate of return. So let us calculate NPV assuming rate of return taking, let us calculate NPV assuming rate of return or discount factor as 10%, sorry, as 8%, sorry, because we found in 8% column, let us take in 8% column. So what is the first year column? And next one, what is that here? Cash flows. What is given in the question? Cash flows. So cash flows are available happily. And now what I want? I want PV at the rate of 8%. What is year column? 1, 2, 3, 4, 5. Keep all the values. All the values. So there's no underline, nothing there. Let us assume this under values, and now red colors will make it as a black color. So cash inflows, what are the cash inflows given? Cash flows 10,000, okay, 10,000, 15,000, 15,000, 12,000, 10,000, 16,000. PV at 8%. So we have to take the present value table values at the rate of 8%. This is first table. Present value of rupee table values at 8% we have to take. How you got 8%? That is based on the fake payback period. We calculated fake payback period. We got 3.968, and I went to present value annuity table, 5th year row. I found the nearest value under the column of 8%. So let us assume discount factor as 8% and calculate NPV by taking present values at 8%. What is the table value at 8%? I already have before question. So just I am copying paste these values here. And now PV of cash flows. PV of cash flows. You will get PV of cash flows. So how PV of cash flows? Cash flow multiply with table value. 10,000 multiply with 0.926. That is 9,020 And next is second year 15,000 multiply with 0.857. That equal to 12,855. Next 12,000 multiply with 0.794, that equal to 9528. Next 10,000 multiply with 735, that is 7,350. Next 16,000 multiply with 0.681, that is 10,896. Let me keep one more row so that I have the total values. So total how much I got here? Total of PV of cash flows 9,260 plus 12,855 plus 9528 plus 7350 plus 10,896, that equal to 49,889. 49. This is the total. Now NPV. NPV, you know already NPV how to calculate. NPV is this. Just I'm taking the formula from here. Let me just cover. NPV at the rate of 8%. Sorry, I took at 8%. NPV. So NPV at the rate of total PV of cash flow. As I told you, cash flow or cash inflow or cash flow of taxes, all are same only, nothing to worry. Total PV of cash flow 49,889 minus what is the cost of the project? Cash outflow 50,000, that equal to how much? Almost nearest value 49,889 minus 50,000. We got negative value of, I'll give 111. Exactly not equal, but nearest value we got. So we got NP negative, and we have to apply the formula, IRR formula. You have to calculate IRR. You have to apply interpolation formula. For interpolation formula, we need two rate of returns. First one, we choose 8% based on the annuity table. And now one more NPV. What is that one more NPV? Another rate of return. What is that another rate of return? How you will know? See here. This is 889. At the rate of IRR, it should be equal to 50,000. That means this value has to be increased. This value PV of cash flow has to increase. If you have to increase this value, you have to decrease the rate. You have to decrease the rate. Decrease the rate means below 8%. Below 8% means you can try anything below 8, 7, 6, 5, anything you can try. Let us calculate one more NPV by taking discount factor rate of return 6%. How I took 6%? Below 8%. Why you took below 6%? Here I have to increase the rate. Increase the amount. If I have to increase this PV of cash flow, increase this value, decrease the rate. If you want to decrease the value, increase the rate. But here I want to increase the value. Since I want to increase the value, I have to decrease the rate. Decrease the rate means below 8%. You can take 7 also, but just I want to take 6%. So now again go back to table, one more column, PV at the rate of 6%. Again go back to the present value tables. Present value tables 6% column, and first year, second up to 5 years values you have to take. What is that one? 6%, 0.943, 0.890, 0.943, 0.890, and one more, go back to the table, 943, 6%, 890, 0.840, 792, 0.840, 0.840, and 0.792. Fourth year, I want one more fifth year value. Fifth year table value 6%. Fifth year 0.747, 0.747. So this values I took from the present value of 1 rupee table, present value of $1 tables. Whatever may be the currency, table values are remain same throughout the whole world. Table are same. So at 6% I took, and now PV of cash flow. PV of flow. So how I will get PV of cash flow? Cash flow multiply with PV at the rate of 6%. 10,000 multiply with 0.943, that is 9, that is, one second, that is 9,430. Year value cash flow 15,000 multi at the rate of 6 at the rate of 6%, 0.890, 15,000 multiply with 0.890, that is 13,350. Third year how much? 12,000 multiply with PV at the rate of 6%, that is 0.840, that equal to 10,080. And fourth year 10,000 into 0.792, that is 7,920. Fifth year 16,000 multiply with 0.747, that is 11,952. And now total, please. Total 9,430 plus 13,350 plus 10,080 plus 7,920 plus 11,952, that is 52,732. This is the PV at the rate of 6% cash flows. Now calculate one more NPV. Same. NPV at the rate of 6%. 6. Total PV of cash flow, that is total flow, fee of cash flow 52,732 minus cash outflow, that is cost of the project 50,000, that equal to 2,732. This is positive, this you got negative. So now you have two NPVs at two different rate of returns. One is at 8% and one is at 6%. This 8%, how you know 8%? From the annuity table I found out and completed the NPV. Since it is negative value, I have to increase this value. I tried the decrease rate of return, that is 6% I tried, I got. Now apply the interpolation formula. This is the formula you have to apply. What is the formula? Lower rate of return. What is the lower rate of return out of 6 and 8? Which is the lower rate? What is the lower rate? What is the lower rate here? Here lower rate means that is equal to out of 8 and 6 is the lower rate. So 6 plus 6 plus brackets, again small bracket, PV of cash flow at 6%, that is 52,732 minus cash outflow 50,000, small bracket close, and divided by, again small bracket, PV at lower rate 52,732 minus PV at higher rate. PV at higher rate means PV of cash flow at higher rate 49,889. Then multiply with difference in two rates of return. Difference between 6 and 8 is 2%. Then again 6 plus and brackets 52 minus 52,732 minus 50,000 means 2,732 divided by 52,732 minus 49,889, that equal to 2,843. And now brackets multiply with 2, that equal to 6 plus, let me take 6 plus, okay, 2732, 2000 numerator divided by denominator 2843, that equal to 0.02 only, and positive only 9609 I got, and multiply with 2. So that equal to 6 plus this 0 point multiply with 2, that equal to 1.92. 1.92 nearest value to that equal to 7.92 percentage is the IRR, internal rate of return. This project internal rate of return is 7.92. How you got 7.92? By using interpolation formula. To use interpolation formula, we need two different rate of returns. Here direct only calculating IRR. So there is no any discount factor, nothing. So that's why we calculated fake payback period by using this formula, and it is 3.968. Go to the present value annuity table, go to the 5th year row, find out the nearest value. I found this value under 8% column. So I took PV at 8% and I calculated the PV of cash flow, NPV. NPV I got negative, then I tried another rate of return that is lower than the 8%, that is 6% I tried. Again take PV at 6% and again PV of cash flow, one more NPV. 2732. Now I have two NPVs at two different rate of returns. Use the formula interpolation, substitute the values in the formula. Lower rate 6 and 8, which is the lower 6%. So 6% plus total PV of cash flow minus at lower rate minus cash outflow. This is lower. Divided by total PV of cash flow at lower rate divided by total PV of cash outflow at a higher rate, that is 49,889. So I took this value. Numerator I got 2732 positive. Denominator I got 2843. Numerator by denominator I got 0.9609. Multiply with 2, 1.92. That is positive only. So 6 plus 1.92 nearest value. So IRR is equal to 7.92%. At this rate of return, where total PV of cash inflow will be equal to total PV of cash outflow. At this rate of return, your NPV will be equal to 0. At this rate of return, your PI is equal to 1. So this is the internal rate of return calculation using model 2, that is direct IRR. By using fake payback period, identify it from the present value annuity table, and then two NPVs, and then interpolation formula. This is another model, only IRR. And you can compare this IRR with the cost of capital of the project company. If IRR is more than the cost of capital, accept the project. If IRR is less than the cost of capital, reject the project. So in this video, I explained about the discounted cash flow methods. There are three important methods are there: NPV, net present value, then PI, profitability index, and IRR. IRR, two models I explained. IRR calculation along with after NPV, and IRR calculation direct IRR. Directly only IRR calculated using fake payback period and present value annuity tables. So this is the about the video part 3 explaining the discounted cash flow methods. So go through the video step by step slowly, and I hope that video will be useful for you. This is the explained. So in next video I used to cover various types of the problems from the examination point of view. From the examination point of the various university levels. So how the questions will be asked, including all methods. Covering all methods, any other new method is missing, that other methods any missing, and completely covering all these methods. I am going to explain in details all the problems, examination problems, in my next video. I hope this video will be helpful to you, useful for you. Please like, subscribe my channel FinTalks by Dr. Hari Curry, and share this video with all your friends. If you have any doubts, please send me a mail or write down in the comments. Any doubt, anything, write down in the comments. I will explain, I will clarify. Or you can send a mail to me, Dr. Hari Curry, DrHarikarri, Curry @gmail.com. Or you can write down your comments in the under comment column. I will try to clarify your doubts, my dear. And if you need any need problem you want to solve, that also you can write down in the comments. Any special topic you want me to explain, or any special question you want me to solve, any problem, examination problems, you can write down a mail to me, or you can ask in the comments column. You can put in the comments column. Thank you very much. Have a good day. Dr. Hari Curry sign off for today. Thank you.